I mean, just an interesting trivia. I think the debt funds in the last 1 year have outperformed the equity funds.
Yeah.
Once Mr. Warren Buffett was asked that what is the difference between you and Bill Gates? Both of you are the two richest people at that point of time. The combined balance sheet of the four central bankers, ECB, UK, US and Japan was $3 trillion.
Okay.
It went to $26 trillion in 2021.
Wow.
See, I think we are in the middle of a mega shift in terms of attitude.
If you had to launch a single disruptive product next year, what asset class would you target? 78% of our viewers aren't subscribed. Help us out, folks, and hit that subscribe button and help us bring you more incredible guests. Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, and on today's episode, I'm thrilled to welcome back to our studio Sandeep Bagla, CEO Trust Mutual Fund. He was last here with us more than 4 years ago. Because that was online when Trust had just launched. Sandeep, welcome back. Welcome back to Paisa Vaisa. Thank you so much for doing this for our audience.
Thank you so much, Anupam.
It is great to have Trust. You guys were, you launched in 2019, so 5 years completed. Tell us, how's the journey been? How's it going?
So, actually it's about 3.5 years since we launched our first fund because COVID had interrupted our start and we started with fixed income funds. And the journey has been very exciting. The Indian mutual fund market has grown by leaps and bounds, and we have also grown. We have subsequently launched a few more fixed income funds and then equity funds. And after we launched the equity funds, we realized how deep and granular the market is and how fast it's growing in India. And that is the very exciting part of the journey, where we have launched 3 equity funds so far: Flexi-Cap, Small Cap, and Multi-Cap. That is, you are interacting with, we have 15,000 distributors empaneled with us. We are regularly interacting with them, understanding the different business models which individual distributors bring.
Yeah.
They are distributors who do everything digitally. There are people who do everything physically. There are people who do only large family house offices.
Yeah.
There are people who do even 100 rupee SIPs. And they have people who are sleeping on the railway platforms are their clients.
Wow.
So it's a huge, it's a fantastic representation of the variety and diversity of India. And the Mutual Fund Sahi Hai campaign has been very successful. AMC has done a great job. SEBI has done a great job. And everybody is benefiting from that growth.
Yeah. Is your product portfolio now complete?
No, the product portfolio is ever expanding like the universe. While SEBI has put in some categorization in 2018, there were certain sectoral and thematic funds which a lot of mutual funds have used to launch a plethora of products. And now we have passive products also. We have smart beta products. Now SIF is coming.
Yeah.
So the product portfolio will never be complete, but I think one should differentiate. There are certain core products which are evergreen, and there are certain products which will never grow to a very large extent, but they are seasonal in nature. So all the sectoral thematic funds will come in the seasonal category, and your Flexi Cap, Multi Cap, Small Cap, Large Cap, Mid Cap, these are all, the evergreen funds.
Yeah. And just for the benefit of our audience, it might make sense for you to introduce Trust, because this is the same question I'd asked you when we were first on our show. Maybe that'll give us a lead into why we're talking about debt fund first, and of course we will go to equity after that. Tell us about Trust.
So Trust Group was founded by Nipa Seth 25 years back. We are going to celebrate our 25 years in Feb 26.
Yeah.
Nipa Seth is a rank holding chartered accountant who started with a very small debt distribution company, then acquired a debt capital market license on merchant banking, then debt broking, debt PMS, and we have done some fantastic deals in terms of debt syndication for companies who want to raise money both in the private and state government sector. In the last 2-3 years, I think we have won all kinds of awards in terms of recognition, in terms of ranking, sustainable bond, best bond advisor, best bond deal. So that has been an institutional framework for Trust Group so far. We also have some companies like wealth management company called Trust Plutus, Trust Securities. The mutual fund foray is the first foray into a retail product. Utpal Seth, our mentor, Nipa's husband, Utpal Seth is a legendary investor in his own right in public and private equities. He has had a fantastic past as an investment banker, analyst, fund manager. He was a CEO of Rare Enterprises for more than 20 years. He was a senior partner with Rakesh Jhunjhunwala ji. And it's very rare to have a combination of promoters, both of whom are on our board, who have actually hands-on experience of investing large amount of money, both in equity and in fixed income. So that way, we are fairly blessed, I would say, to have, very intelligent and wise promoters.
Right.
Now, Trust Group, I would say that in the future of Trust Group, if you ask me, I think the mutual fund is going to be the main driving force, because the market itself is growing by a tremendous speed.
It is.
And the acceptance of mutual funds with retail is ever increasing. SIPs have been increasing. Geographical reach, digital penetration has been increasing. Acceptance has gone. And we have been fairly well accepted by the markets, although it was our first product. So I think that's where the Trust Group is.
And you've got strong promoters, and that is a competitive edge. So how is on the mutual fund side? Last I checked, you were at 3,000 crore plus AUMs.
We are close to 4,000 now.
Close to 4,000 now. So how has it been? Entering into a segment where the big giants were there, well established. How's that journey been so far?
The good thing is that the mutual fund industry, I'm on the AMFI board also, so we have just given our approval for the 50th mutual fund, for the 50th AMC. And I think that at least 15, 20 more AMCs are on the pipeline.
Okay.
A lot of people who have found success in PMS business or AIF business are now converting themselves, stepping in. I think the 75 lakh crore, is kind of a magic number, and everybody feels that this number is only going to increase.
Yeah.
And a lot of, foreign companies who had left the Indian shores are now trying to come back. So I think this number of AMCs was going to increase. There are some which are more passive oriented, some which are more digital oriented, some who might go only into SIFs. And the beauty is the market is expanding.
It is.
And it is accepting. And gone are the days when you thought that, okay, I'm going to invest in only a large brand. Because there have been successes in the recent history where fund managers or AMCs have generated returns consistently.
Yes.
And those names were not household names in India. So people have understood that, okay, it need not be that the most familiar name generates returns for me, so some allocation can be given to a new fund house. The other thing is that one has understood by experience that mera paisa dubega nahi. Maybe it will be 5% down or 10% up because markets are volatile. But it's not a chit fund where money is going to disappear. No promoter is going to run away with your money, which has also led to a lot of new promoters coming into this field. At the same time, it's a difficult market. It is not an easy game to play. People require a lot of patience, lot of tenacity, lot of deep pockets, good set of fund managers and mutual fund professionals to succeed in the business. So, all the best to the newcomers. And I am also a startup newcomer only. But I think people will find their niche. But it's going to be very interesting going forward.
Yeah. So let's start with something that is your strength, an area where you started your first schemes also, which is debt funds. I think that, so where we are in the rate cut cycle with the recent RBI policy holding the rates, what do you think that investors, they have a misconception right before a rate cut cycle begins? What do they think? What's one misconception that you would like to clear?
So, just an interesting trivia. I think the debt funds in the last 1 year have outperformed the equity funds.
Yeah, that's a fact. Yeah,
that's a fact.
Yeah.
I think some of the misconceptions around debt funds are, one misconception is that you will get the returns which are close to the portfolio yield, which is almost never going to happen, because unlike a FD where you get what you see,
Yes.
and suppose the portfolio yield is 7%, but because the valuations of securities will keep changing, only by chance would you get 7%. Most likely you will get 6.5 or 7.5. The longer the duration of the maturity of the bonds, the more the volatility in returns.
Correct.
So I think still I would say debt funds are the domain of large institutional investors.
Not so much retail.
Not
as yet.
so much retail.
Yeah. What one factor, macro or micro, do you trust to signal a shift in your fixed income strategy? What would be that one indicator or whatever it is where you track that and then you shift your fixed income strategy?
People track a variety of things in fixed income markets. They track currency movements, current account deficit, liquidity, RBI stance, RBI actions. But in my mind and my experience, there is one single variable which contributes towards 70 to 80% of movements, which is inflation or inflationary expectations. See, debt market players or as fixed income investors, we are very simple people. We do not want multi-baggers. We do not want to capture the moon. We want our purchasing power to remain intact.
Okay.
Whatever inflation you can project, we would want 1.5-2% higher than that. And that is the end of our dreams and hopes. The problem is that when inflations go up, then yields tend to go up. And when inflation comes down, then yields tend to come down. Correct. Sometimes RBI might be ahead of the curve, sometimes behind the curve. But the primary driving force, and in my mind, the only important driving force behind a bond yield is the inflation expectations.
Okay. Now, debt mutual funds are often compared to fixed deposits. You just mentioned them also right now. What do you think about the fixed deposit? Do you think, it's the most misunderstood, overrated investment, or the way people, everybody talks about it in that way? But is it really that way, or do you have any views on that?
See, I think we are in the middle of a mega shift in terms of attitude of people. See, FDs, fixed deposits, are great because they provide you with a certain maturity date, they give you a certain interest rate, and I think more than that, they give you a lot of comfort that your money is safe. There is an implicit, explicit and implicit guarantee that your money is safe. I think that provides a lot of comfort. So one should not deny the importance of that. But if one were to look at objectively, then post-tax returns hardly beat inflation, which is why the equity investors have done far better. Even debt investors who invest in debt mutual funds, if you are able to play the interest rate cycle well, you remember in certain years, there was a phase, I think between 2000 and 2004, where debt funds were giving returns of 15 to 20% year after year for 4 or 5 years.
Interest rates were falling at that
Interest rates fell from 10% to 5% on government securities. Now, those days are probably gone. You are not going to see those kind of volatile movements. But still, if you are able to, with the help of an advisor or a distributor, if you are able to understand the markets a little better, when you feel interest rates are going to come off, and if you invest in slightly longer duration bond funds, your returns could be much higher than FDs.
Sure.
But it requires some amount of study, some amount of hand-holding, some amount of counseling. And once you get the hang of it, I suppose you would not really want to go back to FDs that easily.
Introduce debt funds to our audience, right? Because I know that they are across, there's a lot of variety in that. There's variety in duration, there's variety in risk. How do you classify debt mutual funds in an easy way for our audience to understand?
So we require, sometimes we require money for transactions. We don't know we are going to use it now or maybe after 2 months or 3 months. Then there are these variety of funds which have maturity less than 1 year. Liquid funds, money market funds. You keep your money there, your returns will be higher than your savings deposits. You will be closer to bank FDs, and you can withdraw the money at any point of time without any penalty.
Yeah.
Okay.
No exit load.
No
nothing.
exit load.
No
Not too much market
pre-redemption.
risk.
Yeah.
No pre-redemption. No discount. No premium. If you have slightly longer horizon, 2 years, 3 years, then it's preferable that you go to short duration funds or corporate bond funds, which invest in longer bonds. So it's like putting money in a longer FD. So you get slightly higher yield or higher interest rates.
And your duration also increases.
And duration increases.
Sure. Okay.
And if you really want to play the interest rate move, and when interest rates are coming down, you could go to the Gilt funds, which have maturities of 10, 15 years.
Yeah.
So there you can benefit because the market price could appreciate if interest rates come down.
So there's something for everybody.
There is something for
As long
everyone.
as they understand कि भाई आप किसमें क्या invest कर रहे हो. People think that debt funds are also like FD and they're guaranteed, but they're not guaranteed. There is risk to that.
Yes, absolutely.
So where is trust right now on their debt strategy? Where we are in the interest rate cycle, where we are in economic growth, where we are on all the parameters that you track. What's your view going forward?
See, my view globally is that inflation genie is out of the bottle.
Okay.
The central banks, the G4 central banks have been printing money like there's no tomorrow from 2008 when the global financial crisis happened. The combined balance sheet of the 4 central bankers, ECB, UK, US and Japan was $3 trillion.
Okay.
It went to $26 trillion in 2021.
Wow.
So they have really printed money.
Quantitative easing. Yeah.
Quantitative easing, competitive quantitative easing. So
Trying
if you
to beat
print
each other.
more, then I will print more, right? That typically has consequences like inflation. But maybe because China was exporting goods, maybe because India was supplying cheap labor, the inflation did not really materialize till post 2020. And the first reaction of the central bankers and the market watchers was this is transitory in nature.
Okay.
So they ignored it, but it refused to come down. See, today we are in a situation where the US Fed, or the largest central banker of the largest economy in the world, they are saying they will reach their inflation target probably in 2028-29 of 2%.
Wow.
And it is much higher. And they are still cutting rates while inflation is higher.
Yeah.
That is reflected in higher bond yields. Because as I told you, bond investors are like Arjun with your eye on the eye of the fish.
Yeah.
तो हमें एक ही चीज़ दिखती है that if it's inflationary, my bond yield will be higher.
Yeah.
So I think globally the environment is not very conducive. Tariffs are going to lead further to inflationary pressures in the US. People like Trump and his advisors are thinking that this is going to be a one-time effect.
Yeah.
But I think inflation expectations are high. And while central banks have started reducing the balance sheet size, they are still cutting interest rates. In India, we are slightly better off. Our headline inflation has dipped to close to 2%. However, our core inflation is still very high. It's about between 4 to 4.25.
Which is within the range of the RBS plus or minus.
RBI unfortunately does not target interest rates based on core inflation but only on headline inflation.
Yeah.
The conventional theory says headline will converge to core.
Yeah.
So expected inflation in India is still 4.25.
Okay.
After maybe 6 months, after 1 year, which is why you put 2% or 2.5%, we are trading at 6.5 on the 10-year government bond yield.
Correct.
So in my experience, whatever the expected inflation for 1 year, you add 2.5%, you get the 10-year yield.
Okay.
And that is a very stable relationship.
Sure.
And that maintains itself over cycles, over years, over markets.
So where do you think, right now, what would a 2 to 3 year or maybe a 3 to 5 year strategy in debt mutual funds be like? Would you, trade on duration and therefore target short to medium term instead of being on the longer side? Or liquids, I assume, are for a different purpose, so let's not talk about that. And on the risk side, like corporate bonds, if you're playing on an economic growth recovery, maybe some risk out there. What do you think is the right way to?
So we are investing in corporate bonds of about, like you said, 3 to 5 year maturity because it gives you a good interest pick up over the overnight rates.
Yeah.
And tactically, we are trading the 10-year, 15-year government securities, which adds to the returns from time to time.
Yeah.
But I do not think that it's structurally interest rates can come down much further because there are 2-3 problems. On the currency side, FPIs have been selling continuously, so there is some stress on the currency front. And I think only if growth tends to slow down should we cut more rates, because growth is fairly robust right now. So maybe RBI will cut in December, maybe not. We are more poised towards no rate cut in December.
Okay, cool. So folks, there you go. That's an explainer on how debt mutual funds work and how to be positioned where we are in the current interest rate cycle. Don't go anywhere. We will be right back. And then we'll talk about equity mutual funds. We'll be right back.
Did you know Indians report nearly 800 cases of online financial fraud every day, which has resulted in losses exceeding 1,000 crores in the last 5 years? To keep you safe from such fraud, I am starting my newest podcast series, Conversation with Vigilante, an initiative by HDFC Bank. In every episode, I will feature special guests who can share expert insights on the different types of fraud, their modus operandi, and how you can protect your money. Stay safe, stay vigilant, and don't forget to tune into Conversation with Vigilante. Catch the episodes on all audio streaming platforms and V for Vigilante YouTube channel.
And welcome back. Sandeep, equity side now. So this entire... I have to start with small mid-cap.
Of course.
Right? You think that, of course, now we are in October. By the time this episode airs, maybe another few weeks from there, and the last 1 year, as you said, debt mutual funds have done better than equity. Small mid caps have also seen a correction in a way. What do you think about the current small mid cap scenario? The valuation, at least. Do you think that's a bubble or things are...
See, bubble is something we will know only in hindsight. By historical standards, we are in valuation territory which is on the upper end of the band. See, India is likely to grow. India is growing faster than any major economy in the world and is expected to grow much faster. But the more important part is we are expected to grow for the next 20 years at a faster pace. So the runway of growth for Indian economy is quite, there are multiple factors for it. One, our average age is perhaps 29 years. For the next many years, a large amount of population will come into the working class, which will add to their incomes, their investments, their consumption. A lot of companies will change their scale in 10 years. So I think that way the Indian growth is somewhat assured or guaranteed. Whether it will be 6% or 8% depends on the multiple things.
Sure.
So the way we have defined, SEBI has defined companies into large caps, mid caps and small caps. Only 100 companies are called large caps, irrespective of size. So the large cap threshold has been growing. Now the smallest large cap companies has a market cap of more than 1 lakh crore, which was much lower 5 years back. The mid caps are only 150.
Wow.
So 35,000 crores and above are called mid caps.
Okay.
I'm saying broadly.
Yeah.
There are 250 companies which are large caps and mid caps.
Yeah.
Now you have 4,500 odd companies which are all called small caps.
Yeah.
Somebody could be as low as 1,000 crores or 500 crores. And the largest small cap would be 35,000 crores.
Okay.
So by no means you can call a market cap of 35,000 crore a small cap.
Yeah.
But we tend to paint them all in the same brush. So you have various indices. The small cap has 250 stocks, typically is what is tracked more widely. Those are the larger companies. And see, India is growing in different directions. Sectors are getting bigger and bigger. More and more companies are getting listed. So the exciting growth phase will be in the small and mid caps.
Okay.
However, the stocks will be volatile. There are a lot of sectors where there are hardly any stocks in the mid and large caps space. Things like chemicals, infrastructure, defense. There are a lot of small companies.
Okay.
These are the companies where the growth can be multifold. This is where the opportunity lies, but this is also where there could be pitfalls. So you require some experienced fund managers to do the hard work and find small caps and stick with them so that you benefit from the growth of the small caps. Some of the larger fund houses their schemes have become so large, they are unable to effectively take exposure in small companies.
Exactly.
For the smaller companies like us, where our fund size is, let's say our Flexi-Cap is 1,200 crores or 1,100 crores. If we want to invest 2%, it's only 25 crores. So we can look at smaller companies also, which is not possible. So I say that, you should distinguish between a small cap fund of a large mutual fund and a small cap fund of a small mutual fund.
Wow.
The
That's a nice
risk
difference.
return, trade-off is very different for those two funds.
As a category, when you look at the AUMs that are parked in the small and mid cap category versus the large cap, you think there's any cause for concern out there? Ki this is cyclical. Small and mids will have their own phase and then large will come back.
Anupam, you're right. We have always grown with this fear. Initial fear was that equity markets is a gambler's den.
Yeah,
Then the second fear was that small caps are all bad.
correct.
The point is that equity markets is far more stable and secure with regulators like SEBI and with the kind of accounting disclosures and the digital way we are tracking different things now. So companies are far safer. Number two, small caps are not small caps. They are very large companies.
Yeah.
The growth, again, the valuations have to be seen in conjunction with growth, expected growth. If large caps are expected to grow between 6-7% for the next 2 years, the earning growth, the mid and small caps at the index level are expected to grow double that. Now, earning revisions can happen up and down, but
Sure.
the growth differential is still there.
Okay.
So, if the growth crystallizes, then valuations will not matter. And if the growth continues for a long period of time, then these companies will grow much bigger in size and valuations will appear cheaper after 2 years.
Yeah. You mentioned Flexi-Cap. Let's talk about that, right? Flexi-Cap category now has more than 2 times AUM as multi-cap. So help me understand this.
Sure.
Why is this, is there something wrong in multi-caps that Flexi-Caps are addressing, or have I understood this?
No, I don't think there's anything wrong. There is a historical perspective. So first, let me define what is a Flexi-Cap and what is a multi-cap.
Sure.
In Flexi-Cap, as the name suggests, there is no limit on any individual market cap category. While the index has about 65 to 70% in large caps, an individual fund manager could theoretically go down to 0% in large caps and invest everything in small and mid caps.
Okay.
So the flexibility which the fund manager has is tremendous. For example, we have a small or mid cap bias because of the growth. We are growth investors. So our portfolios typically have large cap between 40 to 50% and small and mid cap between 40 to 50%.
Sure.
In multi-cap, it is far more stringently defined.
Okay.
25% has to be invested in small caps, 25% has to be invested in mid caps, and 25% in large caps.
Okay.
So it's a far more stringent fund. And why I'll tell you why Flexi-Cap is larger as a category than multi-cap. Historically, people had all kinds of funds. Mutual funds had a lot of different funds.
Strategies.
A lot of strategies. In 2018, SEBI said that you have to categorize funds as large caps, mid caps, small caps, large and mid caps, and multi caps. Now, multi cap had a 25, 25, 25 in small, mid, and large caps.
Okay.
By the structure of the market, lot of fund houses had 60, 70, 80% in large caps. So for them to shift, it would be a big
Shakedown in the
shakedown in the market.
Yeah, obviously.
So they introduced one Flexi-Cap fund where the flexibility was given.
Oh, okay.
I would say 90% of the AMCs shifted their main fund into the Flexi-Cap category and launched multi-cap funds later.
So it was a historical load that's come
So
in
historical money is part of, even now,
Huh.
the biggest attraction or the biggest money flow comes in Flexi-Cap funds because the SIPs are there.
Yeah.
And multi-cap is also now growing. It's grown almost close to 2 lakh crores, or maybe it's crossed 2 lakh crores now. Flexi-Cap would be 4.5 lakh crores.
Yeah, that's right.
But it is the historical perspective that you need to know. There's nothing wrong with either of the funds.
Yeah.
Both of them are doing very well. So, I'm sure multi-cap will soon catch up with Flexi-Cap
Yeah.
funds.
So folks, just a bit of historical perspective out there, like Sandeep was saying, before 2018, mutual funds used to run strategies, irrespective of what the market cap used to be. So you remember those days, a long time ago, some of the largest mutual fund schemes in India in equities used to be, something of focused and growth and vision and long term. You used to have those words out there. You didn't have all the small cap, multi cap, mid cap and stuff like that. Then when this category change happened, a lot of those AUMs which were already sitting in very large mutual fund schemes transitioned to Flexi-Caps, if I've understood this right.
Absolutely right.
And that is the reason why you have this, you'll see that optically Flexi-Caps looks very large cap in comparison looks very small, but there is a historical perspective to it that Sandeep just explained really well. Okay, Sandeep, SIPs.
Sure.
I'm sure that when you joined the mutual fund industry, even as far as I could remember, nobody even counted the number.
Absolutely right.
There used to be like 0, 10, 100, 50, ऐसा कुछ फर्क पड़ता ही नहीं था, and that also used to be at an industry level, leave alone fund level. Now they're relentless. Now, I don't know, sometimes, at least before this market slowdown had happened, RBI has something called embedded expectations in inflation. Here, equity में embedded expectations हो गए थे कि यार देखो stock market में तो 15-20% तो आपका small cap, mid cap जो भी है मैं 12 to 15%. You think that investors have become complacent about market risk?
You are right. I think there is some amount of complacency, especially post-COVID, when markets have rallied so well and small and mid caps did extremely well. So it has attracted a few new investors who don't know much about equities or the volatility or what drives the equity markets. They have just come purely for the returns. But since you raised the topic of SIP is a fantastic tool. It is a bit like what we used to have, it used to put monthly installments in FDs.
Yeah.
Recurring deposits. SIPs, diversify the risk. So no single investor. So today, every month, the mutual fund industry in India is collecting more than 28,000 crores in SIP flows. It's not coming from large investors. It's coming, I think the average is something between close to 3,000 rupees per month per person, per individual. So it's very granular. Now, if you are investing 3,000 rupees and market falls by 10%, it will not hurt you.
Yeah,
if there was one investor with 28,000 crores and market fell by 10%, he would go and sell his entire portfolio. So there's a beautiful diversification, a regularity and consistency of flows, which reflects the propensity of investors, the acceptance of investors, the distributors' efforts to take it, to introduce to new investors, a digital way of investing that has also helped in SIPs. And I think it's been a fantastic, unique success story of India.
Sure.
And a lot of companies, distributors have benefited from that. AMCs have distributed.
Yeah.
In our AMC, although we are a very new entrant, our focus is to constantly work on SIPs. Get new investors, activate distributors, investors, build the SIP book. I think that is very, very important for the long-term success of any mutual fund.
But do you think that somewhere this complacency is, do you think that, does it need any correction in terms of communication, education? I don't know what, because jab tak ye chal raha hai, we're not saying too many people stop their SIPs, but if the market doesn't, keep on going the way it does, can something go wrong?
No, people do stop their SIPs. There is competition from housing in markets because housing markets are doing very well in certain pockets. So people stop their SIPs. There is competition from, expenses sometimes.
So you redeem something.
So you redeem something, you stop the SIP periodically, but the SIP is become far more flexible. Okay. You can stop it for a period of time and resume.
Sure.
You could possibly take loans against the AUMs. It's not recommended, but for tiding over small periods of cash flow deficiency, you don't have to stop your SIP completely.
Okay.
I think if one stays invested for 5, 10, 15 years, I think that risk will disappear.
Yeah.
But if you are a very small, very short-term investor, then the risk is high.
Yeah.
But because the risk is diversified across so many people, I think, for us people who are a little skeptical about this, I think there is no risk. I don't think there is no risk.
You think this 28,000 has an upper limit somewhere? Where you
No, absolutely no upper limit.
Let's hope that's the case.
But that has been the case. I think it has been growing. It's a juggernaut. It is a train which is not stopping, and I don't think it's going to stop.
Yeah.
The speed of the train might, vary.
Yeah.
But the direction is very clear, up and away.
Yeah, that's good to know. If you had to launch a single disruptive product next year, what asset class would you target?
It would be equities because if it's disruptive, it has to be a volatile asset class. It would be no holds barred, no multi-cap. It would be a no small, large cap, mid cap.
Okay.
It would probably be AI enabled. It would be a focused fund, 10 to 15 stocks
Wow.
with very high churn and trying to work on the medium term anomalies of the market. And I believe there are certain strategies which have done extremely well, generated 30-40% returns for the last 5 years consistently.
Yeah.
So maybe something like that.
You think you have something planned in mind? Who knows? It
Well,
For the average investor, is geopolitical risk a real threat, or just what you keep on hearing in media over and over again and social media and this and that? Is it actually something that one should be cognizant of?
I think what has happened nowadays in the last 10, 15, 20 years, the corporates have become much larger than economies or governments. So if we are talking about a full-fledged war, World War III, I think there's a very low probability of that because the corporate powers will prevent that. Geopolitical risks are real. I think the tariff risks are real. The flows have somewhat lowered the volatility of the markets, which could be a good thing. I think the expectations about earnings are still high. And again, the importance of the corporate comes in. But I think the risks are real. But if one has a long horizon, then those risks will go away.
Okay. And outlook for equities, we spoke about your outlook on debt. What's your outlook for equities and hence portfolio strategy for our audience?
The fixed income guys tend to be fairly negative about things.
Okay.
I don't think I have ever seen a picture of a smiling economist. Okay, so, but now I wear multiple hats. I am no longer a fixed income trader. I have understood the nuances and the strength and resilience of the Indian markets. My only perspective here is that if you want to invest in equities, go with, fund managers who are professional, who understand the markets. If you want to do it yourself, do it for fun. Keep 10% aside where you get the excitement of, the market movements on a daily basis. But stay invested in mutual funds for a long period of time. Valuations are on the higher side. They are not really in your favor right now. So you should be prepared to invest with a time horizon of 5 years. By elongating your time horizon, investment horizon, you will be able to tide over any interim volatility. So outlook is uncertain. There are some headwinds in terms of tariffs, slowdown. But again, there are tailwinds in terms of lower interest rates. The GST has come down, so consumption will pick up. The biggest risk, I think, globally, is the inflation risk. It is not clear and present, but it can flare up in the coming quarters. So that is my risk.
What do you think is going to happen from here? Let me give you just what's happened in the last one is that equities in India, at least if you just take the Nifty and Sensex, have given 0% return. Gold has given 40% return, and apparently, it keeps on getting higher and higher each and every day. Silver is in its own zone. So it's very tempting to chase that. But when you see that Indian equities have given 0% and gold has given 40-45%, 1 year down the line, what do you think is going to happen?
See, if inflation remains high and expectations remain high, and if the market feels central banks are not doing the right thing, then your gold and your cryptocurrencies, which are alternate to the currencies and known to be hedged against inflation, will continue to do well. Now, should you sell your house, sell your equities and buy gold at this point of time? Absolutely not.
Yeah.
You could perhaps take a tactical exposure, increase exposure to gold, only if you're convinced that, inflation is a real worry. Otherwise, I think, there will be phases when equities will give you 30% return, sometimes minus 10%. That is the nature of the beast. So you must understand that you have to remain invested. Right now, money is probably chasing, AI generated, sectors which are promising the moon to the investors, and a lot of investments are happening in those sectors.
Yeah.
So in US, probably 6-7 stocks are ruling the roost. India had been growing, so India was getting a lot of money. But now probably the cheaper markets with some amount of, impetus, like Korea, China are getting some money. I think globally the amount of money to be invested is coming down, and gradually it will shift. So money will chase only selective pockets. India remains by and large insulated. We will keep growing at a steady pace for a very long period of time.
Sure.
So we should be seen as a core investment with low volatility, with higher, consistency for a long period of time.
You think that for someone who doesn't understand the nuances of the inflation trade-off, liquidity, gold, and all this, you think hybrids offer some room for them to explore?
They do. I think once Mr. Warren Buffett was asked that what is the difference between you and Bill Gates? Both of you are the two richest people at that point of time. So he replied that nobody in the world believes they can do what Bill Gates has done by creating Microsoft. But everybody in the world believes they can do what I have done by buying stocks. So there is no entry barrier for buying stocks. But we must understand it's a specialized job. We are simple users. We should put money to experienced fund manager who are fairly cheap nowadays. I think one should not try a DIY scheme when it comes to investing. Investing is a serious business. Your future of your family could depend on it. So trust it with a fund manager, multiple fund managers, and stay with that.
Finally, one investment rule you wished you had learned maybe a decade earlier.
If I had learned that one should remain invested for a long period of time, probably I would be a far richer man today.
Well, time is still on your side, so I'm sure there's enough to learn even on the way. And with that very valuable tip, that is a wrap on this episode of Paisa Vaisa. Thanks very much, Sandeep Bagla, CEO, Trust Mutual Fund. Do keep coming back. It's always great to have you here. And I don't know, what are the future plans for Trust? You mentioned one product that you might want to launch, but
No, we will be completing our product suite. We'll be launching more equity funds. And we have 3 words which we have in our logo: clear, credible, consistent. So we hope we are able to launch clear products, have consistent performance, and that credibility is built on that.
And happy 25 years to you next year.
Thank you so much.
That is a wrap on this episode, folks. As always, like, share, subscribe this channel. And Sandeep, thank you so much for doing this for our audience.
Most welcome. It's my pleasure.
Thank you.
Thank you.